In this video, let's talk about two ASX dividend stocks that not a lot of people are talking about. So no banks, listed investment companies, or any of the dividend stocks that I've talked about in the past. You're here for inspiration. So at the end of this video, you should have gotten two dividend stock inspirations and learn why low dividend yield isn't exactly a bad thing. Also, make sure you watch this video all the way to the end because in my previous video, I didn't get to process some of my stock orders. So I'm gonna do a mini portfolio update at the end of this video along with two additional dividend stocks that I'm doing my research on currently. One more thing, if you're interested in learning how to invest in dividend stocks yourself, I've created a full playlist of all my dividend stock videos in chronological order so that you can binge watch that in your spare time. If this is your first time here, my name is David, and if at any point you found this video to be helpful, just gently smash that like button right there, and that's more than enough to support me. So without further ado, let's go! Before we jump into the first stock, let's just quickly go over my selection criteria for dividend stocks. Based on my own research, what I found to be a great dividend stocks usually have three characteristics. One, they have a strong balance sheet to withstand any external shocks in the short term. And number two, they usually have an earnings growth of 5 to 15% over a 5-year period. Because at the end of the day, if their earnings aren't growing, it's very hard for the dividend check to be sustainable. And number three, they usually have some kind of an economic moat or glimpses of an economic moat to defend their ability to grow their earnings in the future. And of course, future prospects of the industry is also important, so I'll make some light comments throughout the video with the dividend stocks that I'm going to talk about. So let's start off with Elders. Elders is an Australian agribusiness that provides agricultural goods and services to our farmers in Australia. So think of providing farm supplies, fertilizers to farmers, as well as helping farmers sell their products. So as of recording this video, Elders was trading at $10.52 with a 1.64 million market cap and a 1.71% dividend yield.
Okay, so before you get mad at me for putting a 1.71% dividend yield stock on this list, just hear me out.
Elders are only paying out 25% of their earnings, and that means there is a lot of room to move in the future to pay out more dividends. Better yet, their earnings growth over the last 5 years have grown by 15.5%. Considering they just started their dividend paying journey and there's still a lot of room for the company to ultimately increase their dividends sometime in the future, not to mention the share price growth have made the dividend yield look really small, yeah, they deserve to be on this list. So let's dig a little deeper into their balance sheet. From a single glance, it seems like they shouldn't have any issues when it comes to withstanding any external shocks in the short term. And the good thing is, their short-term assets cover both their short-term liabilities and their long-term liabilities. With a debt-to-equity ratio of 0.43, which means that for every $1 worth of equity, there's only 43 cents of debt. In my opinion, that's really safe, and they should be able to navigate the turbulent environment moving forward with no trouble. Now, when it comes to Elders' economic moat, I can see glimpses of two moats. The first one is their brand. Elders is a brand that is wholly owned and operated by Aussies, owning approximately 17% of the retail market share here in Australia. And given their size, they have the scale necessary to have a cost advantage over some of these smaller independent operators here in Australia. So essentially, they can provide the same products at a cheaper cost for their customers. And when it comes to the future outlook on supplies for our farmers, I mean, we gotta eat, right? And I don't anticipate that to go away anytime in the future because we have to produce our own food to supply to our own country. So yeah, I think it's here to stay. And full disclosure, I own this stock in WAM Research. Now this brings us to the next dividend stock, and that's Ingenia Communities. Ingenia Communities is essentially a REIT that operates and develops a portfolio of lifestyle and holiday communities. As of recording this video, Ingenia is trading at $4.52 with a 1.47 billion market cap and a 2.52% dividend yield. Now, over the last 5 years, Ingenia have grown its earnings by 10.4%. And even though early in the year, there was the bushfire and now we're dealing with the pandemic, the business hasn't been materially impacted by either of those events. Yes, the holiday communities was impacted a little bit because of the travel restrictions, but just about a month ago, the CEO has came out and said that they're getting bookings ready as the travel restrictions get lifted, and there's a lot of pent-up demand for domestic travel because people can't travel internationally. So let's dig a little deeper into their balance sheet. Now, if we take a look at their balance sheet, and what you see in front of you is actually captured on the 31st of December 2019, their short-term assets barely cover their short-term liabilities. But in April, they did raise $150 million worth of fresh capital. And with the additional fresh capital, they should have no problem dealing with the turbulent environments in the short term. And if we dig a little deeper into their debt to equity ratio, they have a debt to equity ratio of 0.28, which means that for every $1 worth of equity, there is 28 cents worth of debt. Even if the situation have changed over the last 6 months, I didn't read any announcements where they were significantly increasing their debt, so their balance sheet is relatively safe in my opinion. Now, yes, Ingenia Communities' dividend yield is on the lower end at 2.52%, but I want to remind you that even though their dividend yield is at 2.52%, their current payout ratio is only 38%. So that means they're only paying out 38% of their earnings to their shareholders, and this is a REIT. It's normal for a REIT to ultimately pay out 65, 75, or even 85% of their earnings sometime in the future. So there is still a lot of room to move to increase their dividends in the future. Now, when it comes to Ingenia's economic moat, this is where things get pretty interesting. Their main customer base is age 65 plus seniors looking to downsize. And you're probably aware of this, we have an aging population, which means that there's a strong demand moving forward into the future, but there's a limited amount of supply of communities in Australia, especially around the coastal area, and that's where Ingenia is building a lot of their communities. Given they're one of the leading providers in this space, they have the benefit of a cost advantage as well as a high switching cost. Because once the seniors settle in, the chances of them moving communities is very unlikely. And as the supply for Ingenia Communities gets limited and there's a growing demand, that will give Ingenia Communities pricing power, and that will contribute significantly to their profitability moving forward. I mean, think about it. It's like any collectible. As the supply of these collectibles become limited, you're willing to pay more for it. So even if they have the same amount of supply, ultimately people are willing to pay more for it. Now, full disclosure, I don't own this stock as of recording this video, and the two other dividend stock that I am currently researching is John's Land Group and also Cochlear. I haven't done enough research to comment on them, but I just wanted to at least mention it in this video. So if you want to do a bit more research into them, feel free to. So let's wrap up this video with a mini portfolio update. Now, just a mini portfolio update. I mentioned in my previous video that I was planning to invest $750 into my classic dividend growth stocks, and the orders just went through on Monday. And I was planning to invest another $1,000 into ARK Innovation, which also went through on Monday. Now, ARK Innovation ETF is a ETF that's dedicated to disruptive technology. So think of autonomous driving, gene editing, and 3D printing. I'll do a dedicated video on that in the future because a few of you have asked me to do that. And also, the free stocks that I got in Dropbox, GoPro, and Nike, I'm gonna sell off all of these and reinvest it back into Tesla. And don't worry, I'll do a full video on Tesla as well. A few of you have asked whether I can do a full video on Tesla. I will consolidate all of my research, and in the future, I'll release a full video on that. Now, the one last thing I want to mention is that on my Australian portfolio side, I'm not very happy with my Milton Corp position currently, just because they have a very, very heavy weighting towards the banks. But to be honest, so is Argo, but Argo's a little bit more spread out and diversified amongst other industries. And I much prefer that. So I'll keep you posted on what I'm planning to do on my Australian portfolio side, because I am thinking about consolidating, selling off this part, and then invest it back into Argo. So I'll keep you posted on that. Of course, this video is not intended to be financial advice and only for entertainment purposes. That's essentially it for this video. If there are any topics or stocks you'd like me to cover, make sure you let me know in the comment section below. As usual, if you want to support me, just make sure you gently smash that like button right there. In a few days time, my passive investing video will be ready. So make sure you subscribe, click onto the bell so that when that video is ready, you'll be the first one to know. Now, of course, Otto will always do the honors and see you very, very soon.